For the last decade, China's tech sector has felt like a story of just explosive, almost unstoppable growth. But that era is coming to a close. Beijing is fundamentally recalibrating its entire business landscape. They're trading that super fast expansion for a new focus on stability, accountability, and, well, long-term health. Okay, let's dive into what this massive shift is all about. So that's really the core question we're tackling today. This wave of new laws, it isn't just some minor legal update. It is a complete rewrite of the rulebook. It marks a definitive end to that high-risk, high-reward Wild West environment that really defined China's first generation of tech giants. So in this explainer, we're going to break down this new playbook. We're going to translate these pretty complex legal changes into what they actually mean for the market. For founders who are looking for capital, for investors who are vetting deals, and for companies just trying to compete in this newly disciplined arena. All right, let's start with the most fundamental building block of any business, the contract. China's new civil code has come in and dramatically formalized business agreements, turning what were once common practices into some major legal liabilities. The stakes for every single deal have just been raised. Big time. And this right here, this shows you just how massive the cultural shift is. The old way, it relied on these informal, relationship-based agreements. Sometimes it was little more than a handshake or a verbal commitment. The new reality? It's the polar opposite. Precision and formal documentation are now legally enforceable. Ambiguity is no longer a flexible tool, it's a critical weakness. Just think about that in practical terms for a second. That quick WeChat message you sent to confirm a change in the deal terms, that's now a high-risk gamble. The courts are making it really clear that informal channels are just not good enough for making legally binding changes. Formal, documented communication, it's become completely non-negotiable. So how do you actually operate safely in this new environment? Well, it really comes down to a clear protocol. Go ahead and use messaging apps for brainstorming, for the initial chat, but the moment a discussion turns into a real proposal or a change request, it has to move to email. Why email? Because it creates a clear, time-stamped, and formal record. And of course, nothing is truly final until it's in a signed agreement. Under this new code, a solid contract has to have these 8 essential pillars. And it's not just about listing who's involved. You need verified IDs, and for companies, their unique Unified Social Credit Code, which is basically a national corporate ID number. It's not just about what you're selling. You have to clearly define if it's a product or an ongoing service. Every single one of these points is designed to stamp out ambiguity and create a legally airtight framework. Next up, let's talk about the new company law. And this is a big one. It strikes right at the heart of how startups have been funded for years, and it marks the end of what we can call paper capital. See, under the old system, founders could register a company with a massive amount of pledged capital and then promise to pay it in over 30 years. This created a whole landscape of phantom startups that looked really valuable on paper but had no real financial backing. The new system, it scraps that entirely. Now, whatever capital you say you're putting in, you have to actually pay it in. And here's the deadline. 5 years. Startups now have just 5 years to make their subscribed capital fully paid in. So here's the crucial point. It's a put up or shut up moment. It forces companies to be built on a real financial foundation, not just ambitious promises. And that fundamentally changes the risk profile for investors and creditors. And if you think you can just kick back and wait out those 5 years, well, think again. The law introduces this really powerful tool for creditors called accelerated maturity. If your company can't pay its debts, a creditor can just go to court and demand that you and your fellow shareholders pay in your remaining subscribed capital immediately. That 5-year clock just became totally irrelevant, making those commitments a very real and very immediate liability. This theme of accountability just keeps going with our third chapter. That traditional legal shield that's supposed to separate a shareholder from their company, the one we call the corporate veil, it just got significantly weaker. These new rules make it much, much easier to hold individuals personally responsible for corporate debts. The way they do this is through a principle called corporate personality commingling. It sounds complicated, right? But it's actually pretty simple. If you don't treat your company as a truly separate legal entity, if you start mixing its money, its staff, or its assets with your personal stuff or with other companies, the court can just disregard that separation and come after everyone involved for the debt. So, what does this actually look like in practice? The red flags are pretty clear. Using the same finance person across 3 of your startups, that's personnel commingling. Paying a company expense from your personal bank account,
That's financial commingling. If one of those companies fails, the courts can now hold all of them, and potentially you, jointly liable for its debts.
And the law goes even deeper than just official titles. It introduces a new focus on the actual controller, or shikongren. This means that even if you're not a listed director or shareholder, if there's evidence that you are the one actually pulling the strings and directing the company's actions, you can be held personally liable. It's a direct attack on using proxies to try and avoid responsibility.
Okay, so let's pull all of this together. What does it all mean? The new reality of the Chinese tech market is becoming crystal clear. It's more mature, it's more predictable, but it's also way more demanding. The era of just improvising and figuring it out as you go, that's over. The era of discipline has begun.
So here it is, your new playbook, broken down into 4 key takeaways. First, contracts are king. Get them right, get them documented. Second, capital must be real. That 5-year rule is the new litmus test for a venture's real viability. Third, transparency is forced. The lines between your different entities have to be clean because that corporate veil is thinner than ever. And finally, accountability is paramount, and it extends right up to the directors and those actual controllers. And that brings us to our final question. As this new discipline gets enforced across the entire market, who really stands to benefit? Is it the huge established players with deep pockets and big legal teams? Or does this actually create a more level playing field for serious, well-structured startups to compete? The great recalibration is underway, and the answer is going to define the next chapter of Chinese tech.